Good day. My name is Rossouw, and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. All eyes are on America, where the presidential election is now less than 2 weeks away. Despite leading in most national polls, the Democrat Joe Biden can only become the next president of the United States if he wins in a number of so-called battleground states, among them Pennsylvania, Michigan, Wisconsin, and Florida. This week's final debate with President Trump could be crucial in determining the outcome. As of last night, over 45 million people have been infected worldwide, and more than 1.2 million people have succumbed to the disease. The United States remains hardest hit with over 9.2 million infections and 234,000 deaths. India, Brazil, Russia, and France make up the top 5. Europe is now clearly the new epicenter, with infections and death rates declining in South America. South Africa has the 12th most recorded cases. This graph shows just how hard the second COVID wave is hitting both sides of the Atlantic. India is now the only country outside of the Atlantic region among the top 10, and even the tiny Czech Republic reported more new infections than Mexico or Argentina this week. European countries have generally acted proactively, with France announcing a second nationwide lockdown. So far, the only US federal response has been President Trump's claim that beating COVID is one of his administration's biggest successes. Despite their president's claims to the contrary, the US is most certainly not winning the war on COVID. Daily deaths are rising sharply, and experts warn that another 200,000 Americans could die by spring unless the federal government starts taking the pandemic seriously. Mexico, Brazil, and Argentina are still suffering, with the death toll in Europe bound to rise further as new infections are a leading indicator of future deaths. As the second wave rages, most European countries have opted for new measures to limit the spread of the coronavirus. With the exception of France, however, these restrictions are either localized or aimed at specific sectors of the economy. This is already taking a toll on the services sector. In the US, on the other hand, the federal government has adopted a laissez-faire approach, and further fiscal stimulus now seems unlikely. Joe Biden still leads President Trump in national polls, and the oil price remains depressed. This graph shows clearly how the differing policy responses to the COVID-19 pandemic has affected economic activity. In the United States, where the government is loath to impose restrictions, the services PMI is still heading upwards, whereas in Europe and the UK, after an encouraging rise, it is now heading downwards. In Japan, it never really got off the ground. On the manufacturing front, however, the news is less grim. The UK is the only major developed economy where industrial production has already been hit by the second wave. It is probably fair to assume, however, that the same will happen to the economies of America, the Eurozone, and Japan, should the trend continue. After falling off a cliff in the second quarter, the price of crude oil recovered nicely between May and September, when it seemed as if the world was starting to flatten the COVID-19 curve. In recent months, however, the price has started sagging thanks to a combination of oversupply and countries having used the low price to rebuild their inventories. A recent Bloomberg survey found that bullishness is now reigning on Wall Street. The combined market cap of the 6 big technology shares is now worth more than that of the top 7 pan-European indices combined. October was a bad month for most indices and volatility is on the rise. Key concerns remain the outcome of the US election and a second wave of COVID. Despite the volatility, a market crash is unlikely. The sustained rise in the S&P 500 index has clearly had an impact on investor sentiment. As the index has inexorably risen, the gap between bulls and bears has closed and the bulls now outnumber the bears. The stellar performance of the S&P 500 for the year to date is largely due to steep rises in the share prices of Facebook, Amazon, Apple, Netflix, Microsoft, and Alphabet. The combined market capitalization of these tech heavyweights now exceeds that of Europe's seven biggest markets, namely France, Germany, UK, Italy, Spain, Russia, and Poland. Looking ahead, four themes are probably going to shape the investment landscape. COVID is going to be with us until a vaccine is found. China is certainly coming out of the pandemic stronger than any other major economic bloc. Britain looks set to be hurt more than the EU should a hard Brexit occur, and it seems as if a Biden win, coupled with democratic control over Congress, will be the most desirable outcome of the US election. Locally, the week's big news was yesterday's medium-term budget policy statement speech by the Minister of Finance. In it, he admitted a massive revenue shortfall for the current financial year and an alarming increase in government's debt burden. As of last night, nearly 722,000 South Africans have tested positive for COVID-19, the 12th most of any country. Nearly 20,000 people have succumbed to the disease, with Gauteng, the Western Cape, and KwaZulu-Natal the hardest hit provinces. Earlier this week, President Ramaphosa denied rumors that government was about to raise the lockdown level again. In his speech, the minister announced that revenue would fall short of the mark and spending would exceed 2 trillion rand this year. This means that the budget deficit will be rising to nearly 16% of GDP. Public sector wages will hopefully be frozen for the next 3 years, and SAA did get the bailout that it asked for. Good news is that September CPI was below expectations and that a second major new gas find has been made. Based on the numbers mentioned before, government debt will exceed 81% of GDP this year and peak at over 95% of GDP in 2025. At current levels, this means that we as a country are now borrowing 2 billion plus rand per day. If tax revenue doesn't recover and government is unable to rein in its wage bill, the debt to GDP ratio could exceed 100% within 2 to 3 years. Until yesterday, the rand had actually enjoyed a strong week on currency markets and was even trading as low as 16 rand 10 to the US dollar a day before the medium-term budget speech. On the release of the speech, it spiked above 16 rand 45 to the dollar and was trading at around 16 rand 35 to the dollar at the close. Among yesterday's good news was the announcement by the French petroleum company Total that it had discovered a second large natural gas field off the Mossel Bay coast. This field, called Luiperd, follows on the discovery of the so-called Brulpadda field earlier this year. This is expected to add inward investment of 1.5 billion rand and ensure the survival of Petroleum SA. The JSE was weighed down by the gloomy medium-term budget policy statement and is now down more than 8% for the year to date. The rand and bonds also weakened initially but then recovered. Sasol's share price dropped by 10% on Wednesday as Hurricane Zeta approached Louisiana. African Bank has announced that it plans to retrench 1,300 staff, and Michael Jordaan's Bank Zero is ready to launch by year-end. Last week saw a huge outflow of 7.3 billion rand from the JSE thanks to net selling by foreigners, whereas the bond market managed to hold its own and attract a net inflow of nearly 750 million rand. It remains to be seen how the medium-term budget policy statement will affect the numbers for the current week. In a knee-jerk reaction to the bleak news contained in the medium-term budget policy statement, the yield on the SA 2030 government bond spiked above 9.4%. By the close, however, it had recovered back to below 9.3%. The market seems to believe that while South Africa offers exceptionally attractive yields on its government bonds, the country is unlikely to default on its debt in the short to medium term. Before yesterday's sharp fall, the JSE All-Share Index had been trading at around 54,000. The big gorilla on the JSE is without doubt Naspers, which represents over 20% of the value of our total market. If Naspers hadn't been listed on the JSE, the 54,000 level would have been a much weaker 45 to 46,000. Over the past decade, the JSE hasn't been a particularly good investment destination. Average annual returns were in fact below inflation. Over the past 5 years, if one excluded Naspers from the All-Share Index, the average annual return would have been negative, and over 10 years, a respectable 9% becomes 3.5%. The JSE used to be dominated by mining and resource stocks. As recently as 2007, resources made up nearly 50% of the value of our market. Since then, the decline in the sector and the rise of industrial counters like Naspers and Richemont has seen the relative importance of mining decline. This year, however, the poor performance of financials and industrials has seen resources regain some of its luster. Looking ahead, we expect equity markets to remain volatile and fixed income yields to remain next to nothing for the remainder of this year. In this sort of environment, gold could be an interesting diversifier. The local equity market looks cheap, but could become even cheaper unless the local economy recovers. The rand remains a structurally weak currency, and as government's debt balloons, the run in local bonds might not continue forever. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.